Okay, so for now, this is going to be the third and final video in this series where I'm talking about timing luck and how it can dramatically impact long-term total returns if you introduce cash flows, meaning money being invested in an account or money being taken out of an account. The first dealt with accumulation phase, saving money over a shorter time frame, let's say 9 or 10 years. The second dealt with retirement and distribution. This one's actually going to look at much longer time series, so 30 years. And the reason that I'm doing this one specifically is because I want to disabuse people of the notion that planning using just average returns is adequate. So many of the social posts that I see today are about average returns. If you put X amount in an account and it makes 8% per year, this is what you'll have over so much time. And while the math is right on those, the reality is that you don't get average returns very often. You get average returns over 30-year periods, but what you get in any given year usually varies from that pretty dramatically. And when you're talking about investing money or taking money out, the sequence that you get those returns in matters a ton. And I'll show you that here, and then we'll talk about some of the longer term implications of that. I think that understanding long-term average return for equities can be more harmful than good for people if they don't understand the historical context and if they don't know how to deal with that information. So let's start by looking at two separate investors, and what we're going to do is we're going to have them invest $250 a month and inflate that by 2.5% a year every year for 30 years. All right, so by the end of the time series, they're investing a little over $500 a month, and we're going to invest it all in VFINX, which is the Vanguard S&P 500 index fund. Very common, very popular in terms of an investment. The first investor is going to start investing in 1991, and they're going to go to 2021. And the second investor is going to start in 1979 and go to 2009. So equal 30-year periods. And what you'll see is this first investor has faithfully invested and increased their investments over time. And by the end of the time series, they've got almost $700,000, which is a pretty substantial return, right, over a 30-year time period when you look at the ongoing contribution being a little over $130,000. The second investor, on the other hand, who ended in March of 2009, ended with $376,000. So just a little bit over half what the first investor did, even though the time periods were both exceptionally long, 30 years. So what's the difference between the two? Well, the difference is obviously the timing luck between the two, because the first investor's time series ended at the end of 2021 on the back of what was essentially a 12-year bull market in U.S. large cap stocks, and the second one was the exact opposite. It was a 9-year time frame where the U.S. underwent two substantial recessions and subsequent 50%-ish losses in equities. And so the reason why this is important is a few, right? So the first is that people in this day and age tend to equate U.S. large cap index funds with good. I will tell you that as a general statement, I agree with that. But what people fail to understand is that over-concentrating in large cap U.S. equities, even if it's good to have cheap index exposure, is exposing you to a lot of risk because the only return source you have is U.S. equities. And so it's important to diversify into other global equity markets. The U.S. is a lot more boom and bust than people give it credit for. If you look at different time series, 1968 to 1982 was a terrible time to be a U.S. equity investor. 1982 to 2000 was an exceptional time. 2000 to 2009, terrible. 2009 to 2021, exceptional. And so when you look at those kind of time series, what you have to realize is introducing cash flows, again, money going in and money coming out, it matters a whole heck of a lot when you start and when you finish. So if you were going to draw up an ideal retirement for somebody where their accumulation phase was 30 years, what you would ideally want is the first 15 years to be really terrible and then the last 15 years to be great. Why? Because you're accumulating shares early on at a deep discount, and then those grow substantially over the last 15 years. So somebody that maybe had a retirement accumulation phase that lasted from 68 to 2000, well, they're picking up cheap shares the first 14 years, and then the last 18 are amazing, right? But the other example I just showed you, somebody who was starting investing in, say, 79, they were able to pick up shares, but during significantly increasing markets, and by the time their assets had reached a phase where they were pretty substantial, then they had to go through two huge bear markets. And so the other thing that people need to understand about this is that ongoing planning is vitally important. If you're looking at your plan every single year, you have an idea of where you stand in relation to where you want to be. And so if you're 3, 4, 5 years out from retirement and you're invested almost exclusively in equities, and especially if you're almost exclusively in US equities, you have to ask yourself, is it worth the amount of concentration risk you're taking? Is it worth the incremental potential return that you'll get in equities over a balanced portfolio or a balanced global portfolio or a trend following portfolio? Is it worth that incremental risk to remain in equities when you're only 5 years away, when the downside risk is something like a 40, 50, 55% loss? And so you have to understand what this all looks like. If you want to understand more about global equities, read a guy like Meb Faber, Mebfaber. He's a fantastic resource. But if you take away one last thing, this is so important to understand. Average returns don't do anything for you specifically. Average returns are just a piece of information over time, but that's irrelevant to you when you're somebody that's putting money in and taking out. The timing luck that exists in the market is far more extreme than anybody understands. And so when you run plans, you can't just run them once on an average return series that's flat over time. You have to be able to run them specific to your situation, with your specific account balances, with your specific savings and retirement parameters, and you have to run them annually so that you understand fully the range of outcomes and that those range of outcomes are acceptable to you.